morning, everybody. Welcome to this training session. Welcome, of course, to my staff and to those joining us online in particular. Welcome to your first session on this training. So the topic today is SARS Interpretation Note 91. It deals with write-off of tax debts, which is very common. It is something that is often discussed during the preparation of financial statements. People always ask, what must I do with the loan account? It is also something that often comes up in Section 7C comes up. What must I do with the loan account? Can I just write it off? And the question ultimately is, what does the write-off entail? Now, in next week's session, I'll discuss in particular the draft note that SARS issued on 7C, where we'll touch base again on this issue of writing off of tax debts, but not tax debts, loans. But this one in particular deals with what happens when you write off a loan, right? So this is just a disclaimer for our online people. Thank you for joining. This is primarily aimed at my staff. I had this question before, can you claim CPD for this? Look, let me put it to you this way, right? This is professional development. Me teaching you is professional development, right? Whether or not whatever RCB it is you belongs to wants to recognize it as CPD, that's their concern. I couldn't care less. Right? I don't know if they'll accept it or not, but the ultimate aim of continuous professional development is for you to continue to develop professionally. I don't see why this is anything other than that, but they all have their policies, which I will reserve comment on. All right, so let's get to the topic at hand. So Interpretation Note 91. And I want to start this by way of background, right? So let's say company X borrows 1 million rand to company Y, and company Y goes and it uses that 1 million bucks and it goes and buys stationery, right? The stationery expense that it gets will rank as a deduction, so it'll claim an 11A expense. If afterwards, right, if after X has borrowed the money to Y, they write off the loan and say, listen, Y, don't pay me, then you got a deduction for 11A, but you didn't pay for it. You didn't actually incur the expense, right? So the basic logic is when you write off the expense, there must be a recovery of that loan, right? So the whole point of sections 19 and paragraph 12A, which is the section in the Income Tax Act that deals with it, and paragraph 12A that deals with the CGT, the whole principle of writing off tax debts in the legislation is to undo, by consequence of that write-off of the loan, to undo whatever tax benefit it is you got with that loan to start off with, right? So when we think about the types of tax benefits you can get, we can classify them into broadly two types. You get an income tax benefit, so like in the form of an income tax deduction, right? Or you acquired a capital asset, you got a base cost, and you got wear and tear, right, on the asset. So the point is 19 is there to undo income tax benefits that you got, that's funded with a loan when it's subsequently written off. And paragraph 12A is there to undo the tax consequences or the tax benefits you got when you acquired a capital asset with a loan subsequently written off, right? So as with all rules, however, there are exceptions. And what I want to do is, people often keep themselves busy, and I just want to admit a bunch of people here, people often keep themselves busy with establishing whether or not there was a write-off, right? And I'll touch on that briefly. But a write-off, let's just for now consider write-off like a waiver, right? We'll talk a little bit about debt to equity swaps later, but for now, let's just have a look at, okay, what actually happens, assuming there is a write-off of a loan, what happens? So, like I alluded to before, Section 19 and 12A is concerned with what the money was used for, right? You must establish that if you want to establish the tax consequences on write-off. So like I said, you've got 19 that deals with any revenue benefit you got or revenue expense, and 12A deals with the CGT. So now, when we look at Section 19, we can break down the way it applies and by categorizing the expenses you could fund with a loan into three types, which is effectively what the section does, right? It says, okay, there are three types of revenue deductions you can get that's funded by a loan. Either you get a full deduction when you incur the expense, like stationery or rent, right? Or you also get income tax deductions that you claim over time. So for example, wear and tear, right? And then lastly, you also get deductions for trading stock. And the timing of that deduction for trading stock, for us who are familiar with accounting principles, and I'm just looking around the room here for the accountants, right? Are familiar with accounting principles will know that the deduction eventually falls when the sale is made. So what Section 19 does is say, okay, for those three types of expenses, how do we undo the tax benefit when you've had a loan that funded one of those three expenses? How do we undo the tax benefit? So let's look at a category 1 expense, which is you get a full deduction up front, which is the basic one. It's simple, right? You go and you pay salaries with a loan, and the loan is subsequently written off. So let's say you borrow R1 million in year one, and you pay salaries with that R1 million. you'll get a deduction for that £1,000,000. If next year that loan is written off, there's a recoupment in the year that you have the write-off, right? So that's the simple one. It gets complicated as it usually does with tax, right? But that's the simple one. So if it's a normal income tax expense for which you claim the full deduction, right, then you have to reverse the deduction. And here's the example of the stationery, right? Borrowed £100, bought stationery with a loan subsequently written off, £100 is deemed a recoupment in the year of write-off, right? That's pretty straightforward. Right? Category 2 expenses become a little bit more complicated, right? Because when we talk about a category 2 expense, we say that your income tax expense or tax benefit that you got is over time. But now typically we call those allowance assets when you buy an allowance asset, so you'll depreciate it over time. But then you must remember, when you incur an expense with a loan to acquire a capital asset, you're going to get most probably two benefits, or one or two, right? Or both. So either wear and tear claim and a base cost, right? So section 19 and paragraph 12A then starts working together, right? Because there's going to be an adjustment to the income tax benefit and potentially an adjustment to the capital gains tax benefit. And so as soon as you see an allowance asset, you must immediately go, okay, so now I'm going to probably apply paragraph 12A and section 19 in combination, right? So let's look at an example of this. And by the way, guys, for you guys listening here and for the guys online, this interpretation note spans over 100 pages long. There's no way I can cover everything in here, right? I'm just trying to get the gist of the section across. You'll have to go read and deal through the examples in detail. So an example of a category 2 expense where the allowance, where you've got the tax benefit over time, is you buy a laptop for 30,000 Rand on credit, you claim the wear and tear in full over the 3 years, and so that the base cost in year 4 of that asset is null because you had all the benefits in the form of wear and tear. So the benefit that this guy received, the tax benefit, all of it was in the form of an allowance because the base cost of that asset is already null by virtue of operation of paragraph 20, right? So the principle then is that when you write off that loan that funded that capital asset, what is the tax benefit Mr. X or X got here? It was all in the form of an income tax deduction on wear and tear, so we recoup it, and the year is written off, right? Fairly straightforward. What if we got benefits both on wear and tear and on base cost? Because now it becomes tricky, because now already we must say, okay, fine, we need to look at section 19 and paragraph 12A. Right, so let's use this example. X buys a laptop for 30,000 Rand in year 1. At the start of year 2, the loan is written off. So at the point, you must ask yourself the question, and I'm talking to you about the principle. You have to go read the section to see the detail, but as soon as you click, if you click the principle, you'll understand it, right? So at the point the loan is written off, let's consider what types of tax benefits that X get, right? He got a wear and tear deduction in year 1 of 10,000 Rand, and as at the start of year 2, there was a base cost on that asset of 20,000 Rand. So his tax benefit funded with this loan that was subsequently written off is in the form of a wear and tear claim and a base cost. So the principle of section 19.6, then read with paragraph 12A3, is go first and reduce the base cost, which was 20,000 at the point it's written off. Reduce the base cost by the full amount. You can't create a negative base cost, right? So reverse the base cost by 20,000, which means the base cost becomes null. And the balance of the benefit was in the form of an income tax deduction, in the form of a wear and tear allowance, and then treat that 10,000 Rand as a recoupment. That is the basic principle of section 19 and 12A in respect of an allowance asset, right? Now, the trouble comes in is it becomes a little bit more complicated is what happens if I buy an allowance asset with a loan, I then sell the asset, and then subsequently the loan is written off, because there you can see there's a means that you can escape the undoing of the tax benefit. So the section specifically allows for it, and let's use this example to explain it. And please, this is quite a complicated principle, and I strongly urge you to go and work through examples 24 to 27 of the interpretation note that explains this in a lot more detail. I'm getting very basic here and getting the basic principle across. But you have to go work through those comprehensive examples. All right. So X buys a laptop for 30,000 Rand on credit. He claims wear and tear over 3 years of 10,000 Rand a year. The base cost of that asset in year 4 is null, right? And he then sells the laptop in year 5 for 5,000 Rand, and the loan is written off in the subsequent year. What now must you do? Remember, the principle of 19 and 12A is to undo whatever tax benefit it is that you've got, right, on this on this expense that was funded with the loan. So let's look then at, in this example, what sort of tax benefits did this guy get? And this is not how the section reads. This is the concept or the principle behind the section. It says, all right, what did he get? Over years 1 to 3, he got a wear and tear claim of 30,000 Rand, which is an income tax benefit, right? That benefit, if you will, that wear and tear benefit was diminished by the 5,000 Rand that he got, right, when he sold the asset. Does that make sense? Because that would have been a recoupment on the date of sale, right? There's no base cost left on this thing because it's been fully depreciated. So the net tax benefit that Mr. X or Miss, whoever this is, got over the period of this asset was a net 25,000 Rand. 30,000 Rand in wear and tear, diminished by a 5,000 Rand recoupment on the sale. So the basic principle is to say, okay, undo the net 25,000 Rand in the year of sale. That's not technically how the section reads. It says you must go and determine what would have been the consequences if the loan was written off before the transaction, and then compare the two and treat that absolute difference as a recoupment or a CGT. But when I explain it like this, you get the gist of it. And so now when you go and you read the section and you go through the examples, it'll be more understandable, right? The basic gist is go and figure out what was the tax benefit and undo that, reverse it. That's the point. Now, trading stock is, of course, a different animal. For those online joining who are not inclined from an accounting perspective, good luck with this one, right? Accounting and trading stock and taxes pretty much goes hand in hand, right? But what I thought I'd do is before we go into what is the consequence when you write off a loan that was used to acquire trading stock, let's just have a recap again for those who are not familiar with the basic principles of trading stock. So let's say you've got a taxpayer who acquires trading stock in year 1 for 100 Rand and sells it in year 3 for 150 Rand. The basic premise of the Income Tax Act, sections 22 and 11A, will tell you that this is what your tax comp must look like if I isolate this particular transaction. It says in year 1 when you buy the stock, you'll get a 100 Rand deduction under 11A, né? Right? But then section 22 says if that stock is still on hand at the end of the year, add it back, right? So the effect on taxable income in the year you acquired it is null, right? In year 2, opening stock, section says claim it as a deduction. Still on hand at the end of the year, add it back. So the effect on taxable income is null. If then in year 3 you sell it for 150 Rand, then it will go in as a deduction in opening stock. You'll get the gross income inclusion on the sale of 150 Rand, and it's no longer in closing stock, so the value is null, so you get your net tax effect of 50. So now what section 19 must do is it must undo the 100 Rand benefit that you get if you fund trading stock, right, that is with a loan that's subsequently written off, right? Remember, if you buy the stock, let's say you bought the stock here in year 1 and it was sold in year 1, right? Then you will get an immediate income tax deduction already. And so it'll just be a normal recoupment in terms of the earlier provisions we discussed. So however, when the stock is still on hand at the end of the year, that's when section 9 says, okay, well, we need to deal with that in particular, right? So what does it say? It says, before we get to what it says, just want to take another example just to recap again the concept of trading stock. So in this example, we still buy stock for 100 Rand, but the value of the stock diminished in the year I bought it because the market value tanked, right? So we've got a stock write down. Right? And the accountants were going to help me write here. Is the stock write down the right way of phrasing it? All right. So you've got a stock write down. So you've got purchase of trading stock of 100 Rand, and then the value diminished by 80. So you include in closing stock the diminished value. The net effect of which is you get a 20 Rand deduction because that you've been impoverished by 20 Rand by value of the reduction in the market value, right? And then in year 2, you'll open and closing stock 80, and in year 3, when you sell for 80 Rand, you'll have a net effect of null, right? That's the base. This has got nothing to do with section 19 and yet. We're going to get to section 19. All section 19 does is it reverses the tax benefit in respect of stock still on hand. So in the case of stock on hand, and not sold, what it does is it says reduce the value of that stock by the amount written off. So that when we release that expense on cost of sale, at the point of cost of sale, you don't get the benefit of that deduction, right? That's the effect of what section 19 does. So here's an example. Let's say we use the same example as in point 1, and we write the stock down, right? We acquired for 100 Rand in year 1 and sold for 150 Rand in a later year, but the stock, the loan is written off in year 2. I didn't put it on the slides, but you get the gist of it. So we start in year 1, we purchase the stock, 100 Rand. There's no write-off in year 1, right? So we have the 11A and we have the add back in terms of section 22. Now in year 2, the 100 Rand loan is written off. So what section 19 says, it says go and adjust the values of opening stock and closing stock to the extent that you've written down the loan. So in other words, you've got opening stock of 100, which would be your deduction in terms of 22.1, but then section 19 says go and reduce that opening stock value by the amount that you've written off, right? And the effect of that is that your closing stock value is now also null, right? So the effect is null. So the value of that closing stock going into year 3 when it's sold is 0 because of the debt benefit in year 2. And so the effect is that you don't get the tax deduction for the 100 Rand expense, which is fair because you didn't actually pay it because the loan was written off, no? Does that make sense? Right? The same concept applies when we have a stock write-down, right? Or it's exactly the same issue, a stock write-down. It's exactly the same thing. It's just now that we have this reduction of the stock, there's another provision, section 19.4, that says recoup that 20 Rand benefit that you got on the stock write-down when the loan is written off. Right, so it's exactly the same. Does that make sense? Right? You guys follow? So now what we're saying to each other is we're saying, okay, fine. Section 19 tells us how we must undo whatever tax benefit is we got, income tax benefit it is we got, with a loan that was subsequently written off. So we can summarize it like this. And the section is quite difficult to read in isolation, but after this you should be able to navigate it easier. So you have to go and say, okay, fine, what was the expense type, right? And what section covers it. So let's say we've got loans that funded trading stock held and not disposed of, which is the last one we discussed, right? What must you do? What's the undoing? What does section 19 say? It says adjust the value of opening and closing stock so that you don't get the tax benefit when the asset is eventually sold. You don't get that tax deduction, right? So that's specifically in relation to stock held and not disposed of, because they have to deal with this concept of opening and closing stock, right? So that's in sections 19.3 and 4. Section 19.5 deals with loans that funded expenses other than in respect of stock still on hand. So normal income tax expenses, rent, repairs, maintenance, the normal ones. All the section 19 then says in 19.5, it says, well, okay, in the year you write off a loan that funded that sort of expense, just recoup to the extent of the write-off. In all my examples, I've used full write-offs. It becomes a little bit more complicated when it's partial write-offs. SARS Note has got examples of that. You can deal with that. Right. If you've got a loan that funded an allowance asset where the loan is written off before the asset is sold, what does the section say? It says, these, for example, are expenses to acquire laptops, right? Capital assets, where you can claim a wear and tear, right? What it says is reduce the base cost to the extent there is a base cost, to the extent of the write-off, and the balance recoup previous allowances, right? So step 1 is go back. Remember the example of the laptop, where I had 20,000 Rand in base cost and 10,000 Rand in wear and tear, reduce the base cost by 20, and the balance recoup the income tax benefit. It becomes slightly more complicated when you bought an allowance asset, and the asset was sold and the loan is subsequently written off. The basic principle is quite simply this, is you must get to the same result if a loan is written off after the asset is disposed as you would if the loan had been written off before the asset was disposed, because commercially, in exactly the same position. And so what the section says, and this is section 19.7, it says, in effect, it says go and determine what would have been the consequences on the write-off of the loan, right? And what is the consequences on the sale, or what do the consequences be, and what's the consequence of the sale, and treat the absolute difference as a recoupment or as a reduction to base cost, or a capital gain in the extent there's a capital gain. Right, so that is a little bit more complicated, but the basic premise is if the loan is written off afterwards, it shouldn't make any difference. Right, work through the examples, they are crucial, and what I like about this note is, yes, we're talking about specifically recoupments and reductions to base cost, but it covers a wide range of things. It covers and refreshes your basic memory of wear and tear, of recoupments, of base cost, and all those sorts of things. So yeah, it's a little bit random, but the nature of our training, as you all know, is a little bit random, right? It depends on what's new. So right, I said initially the two provisions that we're dealing with, or that SARS deals with in the Interpretation Note 91, is section 19 on the one hand, that governs how do you undo the income tax benefit, and we've got paragraph 12A on the other hand that says how do you undo a capital benefit that you got. Right, so what sort of capital expenses do you incur? You incur capital expenses on which you claim allowances. We've already covered that. And then you get capital expenses in respect of which you don't get allowances, right? And so what 12A, or the point that I'm discussing here in terms of 12A, deals only with those assets where you don't get allowances, because we have effectively already discussed what 12A does in the case of an allowance asset. Right. So let's use an example of a non-allowance asset funded with a loan. Taxpayer X buys a commercial building on which there is no capital allowance. I think SARS uses the example of land, which is, I suppose, more clinically correct because there's no allowance on land, because people might say about, what type of commercial building is this? Is this 13 quid? Let's just assume there's no allowance on this. Funded with a loan which is written off before the asset is sold. Because again here, we must make distinctions between where assets are sold after the loan was written off or before the loan was written off. So in this particular case, we deal with the loan written off before the asset is sold. And what paragraph 12A3 simply says is reduce the base cost by the amount written off, kept to nil. That's simple enough. And that makes sense, because what will happen when you sell the asset in future, what tax benefit would you have gotten? You would have gotten a base cost deduction against proceeds to cap your CGT. And all this thing says is, no, reduce to the extent of the write-off that base cost so that you'll pay effectively more, so you don't get the benefit, which again is fair, because you didn't pay, because the loan was written off. Right. Let's move on. If I can ask the participants online to please just mute your mics if you can. Right, if I can see which one it is speaking, I'll mute it from my side, but I can't always see. All right. So, taxpayer X buys commercial building on which there is no capital allowance, funded with a loan which is written off after the asset is sold. Okay, so now, remember I said it's the same principle on an asset that's not an allowance asset as it is with an asset that is an allowance asset. You must first go and determine what would have been the CGT, what is the CGT, and you treat that absolute difference as a CGT event in the year of write-off. I'm going to explain this step by step. So what paragraph 12A4 says, not in so many words, but that's the gist of it. It says there's 3 steps to determining what the consequences will be. It says step 1, determine what the CGT would have been if the loan were written off before the write-off, right? And then says determine the CGT on the year of sale and treat the difference between the two, or the absolute difference, as a CGT event in the year of write-off. I'll use an example to explain this, right? So let's say company X here bought a capital asset for 12 million with a loan. There's no wear and tear available, right? 2 years later, they sell the asset for 8 million rand, and then the next year the loan is written off after no repayments having been made on the loan, right? So, acquired for 12, right? Sold for 8, and then the loan of 12 is entirely written off after the asset is sold. So step 1, it's a section of paragraph 12A4 says step 1 is what would the CGT have been if the loan was written off before the disposal? What you would have done is you would have had proceeds, if the loan was written off before the disposal, you'd have proceeds of 8 million on the sale, and you would have had a base cost of 0 because you would have reduced the base cost by the full amount, and so you would have had a capital gain event at the point of sale of 8 million. Does that make sense? Because remember, I have to go and calculate what would the CGT have been if I'd written off the loan before the sale, and then calculate what the CGT would have been on that sale. So I must go and say, okay, if I'd written off the loan beforehand, I would have reduced the base cost to 0, right? And I would have then had a capital gain of 8 million because I'd have a base cost of 0, right? What is the CGT actually on the sale? So now we say, okay, what actually happened on the sale at the point that now the loan is not written off, right? So we had proceeds of 8 and we would have had a base cost of 12 because now we assume what is the CGT if the loan was not written off before the disposal. And so, okay, well then we would have had a capital loss, right? And then what it says in step 3, determine the absolute difference as a capital gain in the year of write-off. In this case, the absolute difference is 12 million, which, if you think about it, is the full benefit that this oak received with this loan that's subsequently written off. That makes sense. Please have a look at the interpretation note for detailed examples of partial write-offs, because it does get a little bit thick when you have partial write-offs as well. All right. Just by way of an interesting point to note is you will see that paragraph 12A and section 19 requires of you to determine, for example, what would the CGT have been if you'd sold the asset beforehand, right, before the loan was written off. Now, if you've got assets that are pre-valuation date assets, you'll have to determine the base cost in one of 3 ways. TAB, 20% of proceeds, or, what's the last one? Market value, right? Now, if we have this deemed disposal event, which we have to go and say, what would it have been had we written off the asset beforehand, you need to determine base cost. Well, how would you if you don't have proceeds and you don't have a specific date of disposal? So you'd struggle with TAB because how do you fill in the blanks in the formulas? and 20% of proceeds would also be an issue. So it says in the case we are dealing with paragraph 19 or section 19 and paragraph 12 in the case of pre-valuation date assets, it says effectively treat the date of disposal as the date immediately before the write-off happens, and the proceeds you must consider to be the market value, right? So it deals with that situation that might arise. So how do I deal with this in the case of a pre-valuation date asset? All right. Now I suppose the question is, what constitutes a write-off? But just to recap, you have to think of debt write-offs as I'm undoing whatever tax benefit it is I got with this loan. And then we classify them into two broad categories: income tax and capital assets. And in the case of income tax, we get three types of categories. You've got expenses straight up in the year you incur them, recoup, right? Then you've got wear and tear assets. The point is recover the wear and tear, right, as a recoupment. And then you've got trading stock, which the point is adjust the value of opening or closing stock so that you don't get the tax benefit. In the case of CGT, it's reduced the base cost. In the case the loan is written off before the asset is sold, and in the case the loan is written off after the asset is sold, effectively calculate a capital gain or treat as a capital gain the absolute difference in that year, right? That's the broad strokes of what section 19 and 12A is about. But this all only applies when there's an actual write-off, right? So what is a write-off? The wording used in the section is a concession or compromise, right? I refer to them as write-offs, but write-off is one of the examples of a concession or a compromise. So technically it's defined as a concession or compromise, which means it's cancelled or waived. And by the way, you can only cancel a loan when the guy goes and tells them, you don't have to pay me back anymore. Accounting impairments that you do when you prepare the financial accounts at the end of the year, you say, this loan, it doesn't look like I'm going to recover this, I'm going to impair it in my accounting records. The other guy doesn't even know you impaired it. And even if he impairs it on his side as well, or whatever it is they do for accounting, I'm not going to pretend like I understand accounting entirely, right? That is not a write-off. To relieve a debt, you have to go and tell the guy, you don't have to pay me anymore, right? That is a waiver or a cancellation. You can also do a concession or compromise or write-off, if you will, for lack of a better word, if you redeem the debt or if you merge the debt. Now, people would say, because I looked at this years ago and I said, but how is a redemption a concession or a compromise? Of course, remember, section 19 will only apply to the extent there's a debt benefit. If you redeem the thing in full, there's no debt benefit because you must pay everything, right? But a redemption is a concession or a compromise or a waiver, if you will, of the debt. The question is, to what extent does the section apply? So yes, redemption is a waiver or a concession or compromise, but so what if you paid everything, there's no consequence? Because it only applies to the extent there's a debt benefit. Look at it like this: to the extent that you were enriched by not having to repay this person, right? That is effectively that. The merging of a debt, I've dealt with many examples like this before. There's a shareholder loan, and what do? You distribute the shareholder loan as a dividend in specie to the shareholder. That is a merging of a debt, because the debt ceases to exist because the creditor acquires the claim, right? Or the debtor acquires the claim. I don't know, I always get them wrong, but you get the point. That is a debt benefit. Does that mean necessarily that there is a consequence? It's a waiver or a concession or compromise, technically speaking. That doesn't mean there's a consequence. I've looked at this before on several transactions, and in many instances I have considered that shareholder loan distributions as a dividend in specie does not constitute a debt benefit. All right, for reasons I won't get into here. I had a whole 20 or 30 odd page opinion as to why that was the answer. Right. Debt capitalizations are also often considered. Are they write-offs or concessions or compromises? Yes. The principle is yes. When you do a debt to equity swap, what does that mean, by the way? Because I remember years ago, I was at an audit firm and I was doing, I was sitting with the audit team, and I sat with the audit manager and I said to her, listen, I can see this loan vanishes off the lead sheet here, or off the trial balance. What happened? No, we converted it to equity. I said, but what does that mean? And I remember I was quite annoyed with this person. I said, what happened? Did somebody wave a wand and then the debt became equity? No, the basic principle is I issued shares to settle the debt. I issued shares in myself to settle the debt. So either I issue the shares in myself to repay this loan, or I issue the shares and use the proceeds to settle the loan. Right? The point is, both of those fall within the definition of concession or compromise. That doesn't mean there will be a section 19 recoupment or paragraph 12A reduction in base, because it just means it falls in there. So you have to go and check which ones qualify. Right. Like I said before, you might have a concession or compromise, but the next question is there a dead benefit? And the basic, I can go through this line for line, but that will defeat the purpose. The question you must ask yourself, have I gotten some form of benefit for not having to repay this, or did I repay this in full? It's the same concept. When it's redeemed, do you redeem it for full value? No dead benefit. Redeem it for half the value and the rest is written off, then of course there's a dead benefit to the extent you don't repay it. If you do a debt to equity swap, or debt capitalization as it's often referred to, the question in principle is, was it a value for value swap? What are the shares that you got in exchange for this debt the same value as the debt, or is the shares worth less than the debt? In that case, there is a debt benefit. That again does not mean necessarily that Section 19 applies, because there are exclusions to Section 19. So you could have a concession or compromise, you could have a debt benefit as defined, but the section doesn't apply, right? And these are the examples, right? If you've got a loan written off by a deceased estate in favour of an heir, right, then as long as the loan fell in as part of property of the deceased estate. Because remember, you're going to pay donations tax on it. Estate duty, estate duty. Not necessarily, I suppose, some liability could shield it, but that's not the question. The question is it a loan that's owed by an heir, and the loan is written off in favour of that heir, right? As long as that loan fell into property of the deceased, not dutiable amount, as long as it fell into property of the deceased estate, then it falls foul of Section 19 and paragraph 12a. If the loan is written off by way of donation, in respect of which donations tax is payable, right? Unlike in the case of estate duty, it doesn't say it must fall in the estate and you must pay estate duty on it. In the case of donations tax, it says we exclude it from 19 and 12a if it's subject to donations tax. When does donations tax apply? I mean, donation, and honestly, in my experience, I have almost never seen somebody go, I just feel like I'm writing this off because I'm just being nice. Remember, pure disinterested benevolence. That is the question. Is this really written off without anything in return, without any form of quid pro quo? That's a donation. But then you might say to me, but hang on, what about Section 58? Section 58 talks about deemed donations, where you sell something for less than face value, or for less than market value. That's a deemed donation, right? So you have to test whether something is a deemed donation as well, right? And what SARS says is, in determining deemed donations, well, that's what they say in Interpretation Note 91, and this is quite interesting and important to note for Section 58 in general for deemed donations. Remember that donations tax is a prepayment of estate duty, right? It's to avoid people from diminishing their estates and not paying estate duty. So you kind of pay the estate duty up front. That's what donations tax is, right? So what the note says is, when you are looking at whether or not something ought to be treated as a deemed donation, in other words, because remember the section says, you sold something for consideration which the commissioner does not consider to be adequate, right? So the commissioner says, or at least the commissioner doesn't say, SARS in the interpretation note says that to determine whether or not you sold something for adequate consideration, one must look at whether the value of your estate has been reduced, right? If you write off a loan in a company to which you own all the shares, yes, the company, your loan balance decreases, but the value of your shares go up. So has your estate been diminished? No. So it's not a deemed donation, right? Remember that all that means is 19 doesn't apply, or at least donations tax doesn't apply, and 19 might still apply subject to its exclusions, right? If the write-off of the loan is a fringe benefit, so of course that'll only apply in the context of employment. Groups of companies where the creditor and the debtor form part of the same group of companies and they've been dormant, or the guy owing the money has been dormant for at least, 12 months, for the current and previous year of assessment. Bear in mind here, groups that they refer to as Section 41 groups. What's the difference between a Section 41 group of companies as defined in 41 and a group of companies as defined in Section 1? It's not a percentage per se, it's the local groups. So groups of companies will include international groups in Section 1, whereas 41 is limited to, call it local groups if you will. Right, so that's important. Of course, I'm not going to go into that. The exclusion here, one would think that one would rely on it. People would want to not apply Section 19 and 12 because it's got some adverse tax consequence, right? And so if there's an exclusion to the application of this in the case of group of companies, you can imagine that people will somewhat quickly create a group because you can do that fairly efficiently, right? But there are obvious exclusions to avoid abuse of that exclusion, right? Which I'm not going to go into now. You can go and read that in your own time, right? right? Guys, we'll take questions at the end. I have said to the people in my office, but for those who are online, I'll take questions at the end. Right. Section 19 and 12A also doesn't apply in the case of debt to equity swaps where it's within a group. Again, it's a section 41 group. So in other words, remember we said a debt to equity swap is a concession or compromise, and there would be the application of 19 if there were a debt benefit, right? But then even if that's the case, so you have a debt to equity swap, there is a debt benefit, but it's in a group of companies, no problem, right? Because the section simply doesn't apply, and 12A doesn't apply, right? There's, of course, obvious provisions to avoid abuse of the creation of groups, and then doing debt to equity swaps fall into this exclusion, right? 19 and 12A also doesn't apply where the debt is extinguished during liquidation or deregistration of a connected person creditor. And this is something that's important to take in mind, right? So it's a connected person creditor that owes you the money, and that company is being deregistered or liquidated. The relief only applies in relation to 12A, not section 19. For some reason, I didn't see it in the note, I couldn't be bothered to look at why. The question is there's an exclusion under paragraph 12A, so you wouldn't have a reduction to base cost, but if the loan funded revenue expenses, we talked about the 3 types of categories of revenue expenses that followed, if those sorts of debts that funded those sorts of expenses are written off in the course of liquidation of a connected person, so what? 19 still applies. 12A doesn't apply. So the exclusion in the context of liquidation for connected person creditors is limited to 12A. And lastly, this is an interesting one, is in the case of interest-free loans that is converted to equity, my reading of this section, myself and Vickers has expressed an opinion on this before for someone on those particular set of facts, and the way I read this note is you don't trigger section 19 or paragraph 12A if you do a debt to equity swap in respect of interest-free loans, right? If I recall the logic behind this correctly when they introduced 19 and 12A, because 19 and 12A has got a whole history. There was a string of rulings that was issued by SARS at one stage, especially because remember on debt to equity swaps, right? Where people would ask, well, okay, what is the consequences? Is this a write-off? Is this not a write-off, etc.? And then eventually we had debt to equity swaps specifically being legislated in 19 and 12A. So now you'll see it's a bit odd to have it there, but it's because it's got a history. And nobody knew, it wasn't clear what the consequences would be. And then I remember in the explanatory memorandum, somewhere SARS or National Treasury came out and said, okay, fine, look, the idea is that if you initially funded a business with debt, right, and you didn't charge interest on that debt, what effectively you are doing is you're investing equity. Well, that's because equity does, unless it's a pref share, right? But equity generally doesn't carry a fixed terms of repayment, right? Unless it's redeemable prefs, and doesn't have a fixed interest rate or dividend rate or pref dividend rate. So really, if you advance an interest-free loan to a company, you've effectively capitalized it with equity, right? So if you now go subsequently and you convert that debt into equity, then there shouldn't be a consequence because you always actually intended for this to be equity. And think about this. Let's say I want to fund a company and I say, okay, listen, I've got 2 choices here how I fund you, right? I either put in a debt, so I borrow you the money, in which case you must repay it to me, right? Or I give you capital, in which case, if I'm lucky, the company does well, I'll get my money back and maybe I'll get some dividends, right? If a company, let's say I fund R1 million in equity as opposed to a loan, and they incur expenses for which they claim trading stock deductions and 11A deductions and allowances and whatever, right? And now the company goes bust, right? What am I getting back on my investment? Nothing. Did they still get the deduction? Yes. Is there a consequence for them? No, because it was a capital injection. So why, in the case of an interest-free loan going in, which is effectively the same as equity, why should there be a consequence on write-off when really the intention was always for it to be equity? It was just called debt, right? And so the basic principle is when you have a conversion of debt to equity in the context of interest-free loans, then at a principal level, section 19 and 12A doesn't apply.